Welcome, everyone. Thank you for your punctuality and looking forward to our webinar today. We're going to give folks 2 minutes to get in here, and we'll get started about 1 minute after the hour. As you're getting settled in, just a couple of reminders. One, we're going to keep you muted just to minimize any audio distractions that might come through. As you have them, please do drop your questions in the chat or the Q&A function. We will be monitoring the chat and the Q&A throughout the session today, and we'll open it up at the end of our presentation to field your comments and questions so that we can make sure that you're leaving with your questions answered. But of course, if you do have questions come up that aren't addressed on today's call, and/or maybe you think of something after our webinar, please don't hesitate to reach out. We'll provide you with many different ways in which to connect with us after the fact. So that leads me to my next update. You will all receive a follow-up email that will include our slides from today's session, a recording from today's session, as well as ways in which you can reach out to us, meeting links, our email, contact information, and so on and so forth. So we're about a minute past the hour here. For the sake of time, I'm going to go ahead and get started and let people continue to trickle in as they will. So with that, I'm going to share my slides. Fantastic. Well, again, thank you for joining us for today's webinar. You are on the Reaching Your Credit Union's LID and CDFI Goals webinar. We're thankfully joined with a slate of experts here, one of which is our partners over at the National Auto Loan Network. My name is Ben Herring. I'm the Director of Partnerships with CU Collaborate, and I get to do a lot of different things. And one of those things is connecting CU Collaborate clients with the trusted partners that we have in this space that allow them to move the needle or pull the lever on the various different strategic initiatives that we're working on them with. Today, we have Jeff Bailey, our CDFI Advisory Services Manager here at CU Collaborate, as well as Laura Gooding, who is our Senior Advisory Consultant, focused on our low-income designation work, and then Marco Rasic, who's the President and CEO of the National Auto Loan Network. I'll let them expand on their bios once they get up and running here on their parts of the presentation, but just wanted to give you a little bit of background on who we are. If you're unfamiliar, I do see a couple of familiar names out there, so welcome. Thank you for joining us. CU Collaborate, we're a QSO. We're really focused on credit union growth. So there's a lot of words here, but it really sums up to working strategically with credit unions by connecting them to like regulatory intelligence. And we do that through kind of predictive analytics. We build and operate all our own software and then have consultants like Laura and Jeff who help us deliver on the insights that we're able to glean from our software. So really excited to be joined by a few of our experts today. Just to expand a little bit more on who we are and why we're well positioned to provide you with this content today. We are currently the leading market expansion and analysis company in the credit union space, attributing to, I think, like 90% of field membership expansion applications in with the NCUA. That work allowed us to scale nicely into our work on the CDFI certification retention, the low-income designation attainment and retention, and have, as a result, gotten into other lines of work, including operating a merger network. We have a membership eligibility engine, which I get to work on day in and day out as well. And then doing a lot of stuff on branching strategies, which has been really fun to think through with credit unions around, what does their footprint look like today? What might it look like into the future as we see the nature of branches and the business that's happening at branches kind of like evolve throughout our industry. So just a couple kind of teeing up the presentation for today. There's kind of two main pathways to regulatory relief that we're going to be focused on today. One of those pathways is the low-income designation, and the other one is the CDFI certification, and they're granted by two separate entities, the NCUA and the U.S. Treasury CDFI Fund, respectively. I'm going to actually lean on Laura and Jeff to kind of do a breakdown around how you qualify, what the advantages are of each designation. But in short, low-income designation is based on the number of members that you have that are falling within LID eligibility. And then the CDFI is really focused on lending, right? It's 60% of the dollar amount and the number of loans that you're bringing into the credit union. And those unlock several different advantages. You can see here on the screen, and they're going to spend more time delving into those advantages here in a moment. Here's the thing. A lot of credit unions right now either are low-income designated or might qualify and don't understand fully the advantages and are not extending those advantages as a part of their mission into our communities. And we're really wanting to work with credit unions to leverage those benefits to trickle down back to who we are here to serve, which is the member, right? And so I'm not going to spend a whole lot of time here. I'm actually going to go ahead and hand it off to one of our experts, Laura Gooding, who focuses on work with the low-income designation and our clients in this space. So Laura, great to have you on the call today.
Thanks, Ben. So I've been with CU Collaborate about 4 years now, and the last year and a half, 2 years, I've really started specializing in low-income designation and helping credit unions through this journey. So I'll do a high-level overview of how LID works and some of the ways that CU Collaborate can help credit unions attain it. So low-income designation, generally there's 5 main benefits. The first is the ability to accept non-member deposits from any source up to the greater of $3 million or 50% of paid in an unimpaired capital. This benefit is useful for things such as mergers and acquisitions because it can kind of smooth the path of being able to take on those non-member deposits while you're still in the process of memberizing new folks. Or if you're looking into something like reciprocal deposits, if you've got deposits that are in excess of the NCUA insurance limit, you can swap those deposits with other institutions and then keep people's deposits fully insured. There's also the exemption from the compliance with the member business loan cap. This is one of the most common reasons that credit unions are pursuing LID, but if this is a part of your strategic plan to continue growing your business line, LID could be a strategy to help keep that limit from applying to you. There's the ability to apply for technical assistance grants and low-cost loans from the CDRLF. This one is more limited to credit unions of smaller asset sizes. So for like 100 million to 200 million range, this is more of an applicable benefit for those sizes of credit unions. And then there's the ability to include subordinated debt in the net worth ratio calculation. This last one, expanding members to others affiliated with the community, is generally limited to federally chartered community credit unions. But what it does is it allows federally chartered community credit unions with LID to expand their field of membership flexibility by including people who perform volunteer services or participate in community associations. So we know that LID can feel like a moving target, and that a lot of the time is because the NCUA updates its workbook annually. So the designation of low income is not the poverty line or a designation by the CDFI or anything like that. In this instance, it's a benchmark determined by the NCUA and their regulations, and then using the latest American Community Survey 5-year data, they generate a new workbook each year that gives us the list of geographies at a county, census tract, and census block group level of what geographies are LID qualifying. Last year, about 61.5% of the US population was living in a LID qualifying geography, but the NCUA actually released a new workbook last week, so we'll have estimates soon on the impact that that's going to have on your LID percentages, and an upcoming webinar to keep an eye out for. Generally, there are 3 paths to LID attainment. The first is through actual members using the information available in your Aries share file. This is the standard path to LID attainment. Next is looking at your low income community, which would be tweaking your field of membership to be community chartered and have a potential membership that is majority LID qualifying areas. The third path is the road not yet traveled, but it is within the NCUA regulations of doing a loan analysis. So taking a random sample of your loans and determining if a majority of your loans are being issued to low-income folks. I'm going to focus on the first two categories of actual membership and potential membership because those are tried and true at CU Collaborate. So actual membership, the idea is that the majority of your members have to qualify as low income. Most of the ways that people count are by living in those green geographies we showed a few slides ago. The next few ways, there's high school aged members, so ages 14 to 19. That counts towards LID as well. We determine we determine the percentage that they'll have on, or the impact they'll have on your LID percentage by taking the date of birth of your members, and then we prorate those members according to the high school attendance rates of the state in which they live. So high school members count for a little bit less than 1, but they do still generally boost your LID percentage. Then there's college, university, and vocational school students. These ones are not prorated. However, the NCUA is very picky about how these students are identified. And there's a couple of routes to do that. And we can help if you want to identify via the National Student Clearinghouse, or if you wanted to go the route of surveying your members. The trick with this bullet is that this data can expire because the enrollment status of students can change. And then the last group that qualifies for LID is active duty military members. Like high school students, this one is prorated at about 0.534. So if you identified 2 military members, one of them approximately would count towards your LID percentage. This is one where I typically recommend this as like the last wave of data cleanup or additional enrichment, because the impact tends to be much smaller than the other 3 categories listed. Because the NCUA is also quite specific about how to identify military members, and a lot of the time military members are already living in low-income qualifying areas, so you may not see those returns from identifying them as being active duty. For those who do not qualify, there's residents of non-low-income areas, and then there's members with PO box addresses. They don't count because PO boxes can't be geocoded. An example I give a lot is like, I live in Denver, which is mostly LID qualifying geographies, but I could open a PO box in, say, Breckenridge, which is not LID qualifying. And if you were to see my member record with that PO box in Breckenridge, it doesn't actually tell you anything about where I reside. As a result, PO boxes are automatically counted as non-LID qualifying when we geocode the ARIES file. Then there's members with business addresses. This one is a little sticky at first because it's different than the way that credit unions identify businesses. We know that credit unions attach a flag or some kind of account identifier to identify business accounts, but how this works is we match the NCUA's procedure, which is we look at if there's a residential delivery indicator on that address, which comes from the United States Postal Service. If the USPS says, yes, this address is a business, then it's counted as a business in your LID results. Next slide. So that was the overview of actual members. The other main route is potential members. In certain circumstances, this could be a more efficient approach to obtaining LID. Like if your geography is not favorable to, or your field of membership geography is not favorable for attracting a lot of LID members, maybe it'll be faster to hit that 50% plus 1 mark if you change the borders of your field of membership. This is for community charter credit unions, and the majority of the potential membership has to meet that low income definition. Next slide. So this is an example of what that could look like. This credit union adjusted their field of membership from being the counties shown on the left side, where the LID population was 32.34, and we expanded it to include those additional census tracts, getting the potential population to a point where 50.67% resided in LID qualifying areas. So they first applied for the field of membership expansion. Once approved, they were able to also get LID. There's key steps in LID attainment that pretty much all credit unions go through when they work with CU Collaborate. We start by determining the baseline. So we take your Aries share file and we review that current data to see where your percentage falls. Then we go through a process of data cleanup, so standardizing records, identifying things like unknown records, PO boxes, consistency and formatting, so that we can make sure that the baseline is as accurate as possible. Then we look at data enrichment. So is there opportunities to identify members who might boost your percentage further? Can we add dates of birth? Can we find college students? And even can we identify military members? And then once that baseline is established, if we're above 50%, great, we can move forward with submission. But more often than not, it's a combination effort of data cleanup plus strategic member growth, targeting low-income members, low-income geographies, finding ways to bring more low-income qualifying members through your doors. Once we hit that 50% mark, we submit to the NCUA and secure the designation, at which point you'll have it for at least 5 years, which is dependent on the timing of when the NCUA does their exams. And as long as you're above that 50% mark, you're good to go. If you fall below the 50% mark, you're issued a cure notice and this process starts again. So I mentioned several times many things that CU Collaborate can do to help with this. At a really high level, we can help with data, we can help with mapping, and we can help make decision making a little bit easier. With Analyze CU, we can take your Aries files, both share and loan, and help you understand where members are located, where there's opportunity for data enrichment. We can model high school students and college students. We can export these reports too so that you can make data-driven decisions and understand at a granular level where shifts may be coming from. We also have the ability to visualize LID areas in your FOM. You can map your current FOM, overlay this with other demographic details like income or age, and be able to really think about where you want to be doing marketing in your field of membership and identifying those geographies for outreach. This tool is also helpful for building targeted LID marketing lists. If you know that there's areas within your field of membership that you want to reach, but you want to focus that area to being LID qualifying areas, our mapping software and our API are ways that can help narrow that focus. And then we've got the LID API, which helps support things like our lending pipeline, and you can build it into finance and merchant lending, targeted marketing software. What this does is it identifies immediately, is this a LID qualifying location? Yes, no. And it's updated with the new LID workbooks as they're uploaded into our software, so that if you are using the LID API to support decisioning or outreach, you're able to have that continuously updated information each year without having to make significant changes on your side of things. And I will toss it over to Jeff to talk about CDFI.
Thank you, Laura. So Laura and I both are within the department here at CU Collaborate that we call beneficial regulatory programs. And that's because LID and CDFI are sort of often thought as being related from as Ben mentioned earlier, there's an actual distinction in terms of the entities that regulate the programs, but folks that we work with are often looking at LID and CDFI to see what solutions that they may offer and understand how they may fit into the program. So CDFI certification is really the designation that helps one gain that access to grant capital that either supports the type of work that you're already doing or perhaps provides a carrot or incentive for folks to operate in a space that they may not otherwise be currently serving. So as far as the opportunity from becoming a CDFI, the vast majority of credit unions that we work with are seeking to obtain the grant capital that exists from the CDFI Fund. Forgot the table here shows the 3 different awards that are typically offered. Those who were working in the space during the pandemic know that several grant programs were created and distributed. I think of those as being much more one-off programs that aren't offered annually in the same way that these are. So really, I would ignore those past opportunities and focus on these 3 that we consider to be regularly occurring. And I'll just go left to right here and describe the features of these 3 programs and how they may fit with a credit union who's interested in taking advantage of the opportunity. The Technical Assistance Award is only up to $150, or excuse me, $150,000. That so it's relatively small compared to the other 3, but it's quite flexible in how it can be used. It falls under the broad umbrella of capacity building. So really, it's investments that one might make in order to support the community development programming that you offer, and that can be used, or the award can be obtained by a CDFI that is already certified if they are below $250 million in assets. But the award can also be obtained by any entity seeking certification. This is what the CDFI Fund calls an emerging CDFI, and can be obtained prior to obtaining certification regardless of asset size. So that in a lot of ways, the TA award, technical assistance, is a foot in the door toward certification. Once certified, you have access to the Financial Assistance Award, FA. The FA award you can request up to $1 million. It's typically used for capital reserves or loan loss reserves. And the purpose of that award is to facilitate growth of the credit union. For any of these, the CDFI Fund is not really interested in funding business as usual. They want to fund expanded access to capital to underserved communities. The final award round is the small dollar loan program. You'll see, which is currently active. This program up to $500,000 can be requested to be used for loan loss reserve as small dollar loan product or operating expenses, or I guess I should say, or operating expenses associated with the small dollar product. And that can be used for a new product or one that you're seeking to launch. So that's the benefit. In order to obtain those benefits, you basically need to get CDFI certified. We have here 4 of the 7 requirements for certification. These are the most relevant for the other 3 credit unions are somewhat presumed to meet. And of these 4, they're represented sort of equally here, but the top left quadrant, 60% target market lending is sort of the most infamous requirement that that folks may know about, and serves as probably the largest gate to pass through. In addition to meeting the lending metrics, there's one's board has to meet the requirements that the CDFI Fund stipulates. There has to be a primary mission, responsible financing practices in place, and there has to be technical assistance that's offered in addition to the target market lending. So if you've heard of CDFI Fund or you're familiar with it, you probably have a familiarity with what I just described in terms of the challenges and opportunities, but wanted to provide here an update of what we're seeing at the CDFI Fund, because if you've heard of those other things in the past year and a half, you've probably also heard that the CDFI Fund is not operating, or it's under threat, or it's the staff is being reduced, they're not giving out grants. So, and it's true, there has been somewhat of a indirect or unintentional pause over the past few years, while there's been a lot of work being done in the background at the CDFI Fund. So what we're seeing is that recertifications are moving. We're starting to get certification applications that were submitted last year being approved. We're really excited to see that breakthrough after about 9 months where we didn't really hear the results of anything. We're seeing the program continue to be funded by Congress. There was a movement to sort of defund the CDFI fund, and it was resoundingly bipartisan in its support for the program. So we were excited to see it continue. And then the 2026 SDL round opened up this year. And so what we're really seeing is, a grant round open up for the first time since January 2025. And so we expect, that to indicate that there's additional grant rounds that will continue to open up after a pause there. We can go to the next slide, please. One of the things that I just want to highlight here is that many credit unions do not consider participations and purchases. And so what we're really seeing is that if you don't consider them, there can be some negative consequences to doing so when you do try to meet that target market requirement. But if you do so intentionally when considering CDFI, then there can really be a lot of benefit in terms of meeting the program requirements. So with that, I'll pass it back over to Ben.
Fantastic. Thank you, Jeff. And I think, when it comes to the credit unions that are coming to us, many credit unions kind of qualify either organically or intentionally for both. And many start off with the low-income designation, and partially because I think like the rigor that it requires is a little bit less than the efforts around the CDFI fund. But in short, they're obviously two separate programs. And what I'm hearing from both Laura and Jeff here, and I think a lot of the conversations that we're having, is that oftentimes attaining and retaining access to both of these programs requires intention. And that's why I wanted to share a little bit more about how CU Collaborate partners with organizations to help you move the needle. We have a lot of different types of partnerships, including lending organizations that can deliver deposits for credit unions, and really organizations that can help us focus on growth, including capital markets companies, corporate credit unions, et cetera. To give you an understanding of the impact that our partners had, I wanted to provide you with a really concrete example. So I brought on Marco Rasic, who's the president and CEO of the National Auto Loan Network, to share with us a little bit about how they're working with credit unions to help reach their LID and CDFI goals. And I just wanted to kind of like highlight the story, and then I'm going to hand it over to Marco to tell us a little bit more about who he is and what the National Auto Loan Network does. But a couple of years ago, we got a call from a credit union that said, "Hey, I'm at risk of losing my low-income designation. I received this cure letter about 4 years ago. We have about a year left on our clock. Help us. How do we get back into compliance with the low-income designation is a critical aspect of how we do business." And we went to work. And at that time, we were thankfully partnered with the National Auto Loan Network. Marco, if you could tell us a little bit more about who the National Auto Loan Network is, what you guys do, and how you help credit unions with their approaches to both the low-income designation and CDFI.
Yep. Ben, thanks. I appreciate the introduction. The National Auto Loan Network is a company I founded back in the year 2010. We are a California-based business. I have a team of 150 people, and we work with credit unions across the United States. We also work with the credit bureaus directly. What we do is identify consumers that have a current and performing auto loan, and then we have an ability to, based on credit criteria, reach out to these consumers via direct mail. So we hyper-target consumers across the United States. And we bring these consumers an opportunity to refinance their current loan, and a very simple call to action in order to do that, either go online or to call us. As a part of our process of completing the application with a consumer, we have a direct connection API that is with CU Collaborate, where we, on a loan-by-loan application basis, we're able to know if a consumer would be LID eligible and or from a CDFI area. So we're able to do that on an application-by-application basis. So we can really, what I'll say, dial a campaign could be member growth, right? Or it could be specific to CDFI areas and or LID eligible consumers. So we're able to do that. We're very fortunate. We're a 16-year-old business, and we've had a partnership with CU Collaborate now for a couple of years, and we appreciate the opportunity.
So tell us a little bit more. Thank you, Marco. And yeah, tell us a little bit more about what you were able to do with this particular credit union on their LID journey.
Yeah, so we focused on LID eligible consumers across the United States. We were able to date, originate more than 4,300 loans. More than 4 out of 5 consumers would be considered LID eligible. We provide with a loan package. We provide, when they memorize the borrower, we provide a statement of eligibility that we receive from CU Collaborate through their API. In this case, we're able to do that more than 80% of the time. And then, part of our process is we have a consumer who's paying on time for their current loan. We want to set them up with ACH origination immediately, right? So we want to set up an automatic payment at the time of origination. So we do that more than 90% of the time.
Fantastic. And I do want to be conscientious of everyone's time. We have just a couple more slides here. Marco, just tell us a little bit about what you're doing to date in partnership with CU Collaborate to deliver for both LID and CDFI focused credit unions.
So far, we've been able to originate more than 12,000 loans with consumers across the United States for about $310 million. So whether a budget would be $1 million a month or $10 million a month, we're very, what I'll call, flexible on the ability to run a campaign specifically for a partnership. So we don't necessarily have to have certain a certain takeout every month. It could be really done on a quarterly basis. So pretty straightforward, depending on your budget.
And lastly, can you just tell us a little bit about how this kind of like supports the growth, and then we'll wrap it up.
Yeah, very straightforward. Nothing is no contribution, monetary contribution by the credit union at all. We run all the campaigns, specifically direct mail, using our National Auto Loan Network brand. The only time that there would be any commitment financially would be in the process to run a bureau on your side and to ultimately decision and onboard the member at that point to fund the loan. So, very straightforward. And, we look at the opportunity for each individual campaign. So we're able to scale up appropriately as we go through our partnership. All right.
Awesome. Yeah, I know. So again, I know we're a minute past our time here. Would love for anyone, if you have any questions, to drop them in the chat or Q&A. If you do want to bring your questions offline, you can use your phone to scan the QR codes that are on the screen here, whether it's a LID question, CDFI question, or want to talk a little bit more about how we partner with organizations like the National Auto Loan Network to help with your strategies. Really appreciate everyone's time here today. Any questions? And I will say, as you're thinking of those, auto loans are one of those things that credit unions get, and I think that's part of why our relationship with the National Auto Loan Network has really seen success in this vein. It's really been fun to watch credit unions kind of like move the needle on their various different initiatives, whether it is member growth, loan growth, trying to hit your CDFI targets, trying to gain more members in LID areas, or whatever your strategy is. It's been really an eye opener, I guess, to see how credit unions are leveraging their existing expertise and service to credit unions to grow. And so kudos to you all out there who are focused on this. With that, I don't see any other additional questions coming through the chat. Just lastly, Laura kind of briefly mentioned this. We are going to have a deep dive into the NCUA's updated LID workbook coming up in August. If you'd like to join us for that call on Tuesday, August 18th, please feel free to scan and register here. She's going to go through what we just received, which was a shift in LID areas. We're getting used to it. We're updating all of our software to be in compliance with the new LID workbook, and we'll tell you what that means for you and your credit union. Thanks, everyone. Thank you, Laura, Jeff, and Marco. Have a wonderful rest of your day.
Thanks, everyone. Thank you. Thanks, Ben.
Thank you.
Jeff, Laura. Thank you.
Thank you.
Take care.
Bye.